Tucker here, usvetwealth.com. Wanted to show you a little bit about how this advanced equity insurance policies, the modern ones that are available today that we're using in as a part of the Survivor Liberty Plan to solve this military pension protection problem that everybody finds out about at the end of their career when it's too late to make a decision almost. Well, it's not too late, and you just got to understand what's really out there, and then you can make an informed decision. That's all we're trying to do here. So we made this graphic to show what's happening here. So like any cash value or permanent type policy, basically you're putting money when you pay your premiums. It's not all just for cost of insurance like with a term policy. The vast majority of it is going into an account that can be invested in lots of different ways that you're able to do this. But don't forget, there's fees involved, of course, absolutely. And to compare this to a term and invest the rest, or even just to compare it to the cost of investing in the market, frankly, it's apples and oranges. But that said, happy to show you comparison. We'll show you that on the next slides. And I think you're going to be quite shocked because most people don't realize how much they're paying for things like 401ks and mutual funds and stuff like that. Not that it's bad to do that. Just be aware what's actually happening, right? So most of the money's going in the account. So really we're funding an opportunity here, right? This isn't about death benefit here. Yes, there's a death benefit involved. That's what gives us the IRS allowed limits to get all sorts of tax-free growth inside this account. Now, the way it grows is it's linked to the market, but it's not at risk of loss in the market. And how they do that? Options and futures contracts. If you don't know what that is, it's simply saying that if we buy an option on the performance of the market, that doesn't mean we're invested our money in the market. If you put $1,000 in the market and it goes up 10%, you're going to get $100. If it goes down 10%, you're going to lose $100. But your $1,000 is always at risk. In this account, your money's not at risk. It's in a fixed account. It's in a fixed account, which earns around 4% interest. However, the insurance companies use a portion of this premium amount to buy an option contract. So instead of investing $1,000 at risk in the market, you'd buy an option to invest in the market at a later date. That might cost $20, $50. So obviously the risk level is very low, and they do 1, 2, and 3 year options, and simply they'll look back a year later and say, hey, is the market up? Cool, we'll execute the option. Get the same 10%, 20% rate of return, whatever it is, and that way you can get the growth without as much risk. If the market's down, okay, we don't execute the option, we lose $50. So that's how that works. Lots more info on that. I just want to give you a quick overview. But the point is, the money can grow. The money can grow a lot more than it would with kind of the old school whole life policy, which is a declared dividend. It's just a committee. Each year, the company says, hey, how much money do we make? Okay, well, let's give them 5%. Nice. And on average, that's done okay over the decades, but there's plenty of evidence to show that declared dividends are decreasing as these older school firms aren't able to keep up with the modern changes in the economy, much like Blockbuster and Netflix, right? So this is the free market, and as liberty-minded people here at Vet Wealth, we're all about free markets, right? And then, of course, there's opportunity here. How do you use the money? There's no rules like with anything in a retirement account. Just as an example to compare, like if you're doing retirement accounts, you can only put so much in each year. With a Roth IRA at $5,500, you can only put that much in, and then you can only use it for retirement income after age 59 and a half. Like that's inflexibility. That's in no control over how you want to use your money. In this economy, we like all the opportunities out there. So we want our clients to be able to maximize their resources. And frankly, this is the only way right now to be able to do it without taking crazy risks of doing stock trading or Bitcoin or all that kind of stuff. So, here's just some ideas of ways you can use it and when you can use it. There are no rules. Start a business, use it for transition, give yourself, a pension. and ultimately be able to leave a legacy. So we're gonna pull up the slides. I wanted to go deep on this slide where it's simple, because anytime you're doing illustrations or projections or financial plans or charts or graphs, listen, it's always a hypothetical. Nobody ever knows how the market's going to perform, and so that's why the typical rate of return that they show for the S&P 500 is around 8-9% per year. That's how it's averaged out over the last 4 decades or more. And that's nice to say, like, hey, it averages over the long term 8%, but that doesn't account for those years that it's down when you actually need to use the money. In this scenario, that simply doesn't happen because there is no risk of any loss in this account. So if the market's crashing, we just stay at zero. Cool? All right, so in this scenario, we've got a guy who had a whole life policy. He had $10,000 in the cash value of the whole life policy. So he did what's called a 1035 exchange. And then he wanted to add another $10,000 per year for 20 years. This is a real scenario with a client we're working on. So so that's why he's got 20,000 premium in the first year, right? And that's going to get him a $300,000 death benefit. Again, that's not why we're doing this policy only. This is in addition to the convertible term to get him the proper amount of death benefit coverage to cover his pension or whatever else that he wants to cover. But the key numbers here are knowing, what are we going to be able to access and use when we want, how we want, and how is it growing. The illustrated rates here that we're showing are really only at 6%. Because we know that we want to be super conservative and not, be crazy and try to show 8-9%. But these actually do perform at about the similar rate, but we don't even show that. So in this scenario, by age 59, 20 years into the policy, he's put a total of $210,000 in the policy, right? And he's got close to 400,000 now available, almost doubled in those 20 years at a 6% growth rate without risk. And notice, of course, the death benefit has gone up as well. He's thinking he's probably not going to retire to 66, but for whatever reason, he's like, I just want to do 20 years of investing, and then I'll let it ride for a while. And then what could I do when I am retired and want to stop working fully? Well, by this point, he's got close to 600,000, and he can actually pull out $46,000 a year, and we can easily see by the 5th year of pulling money out, he's already pulled out more money than he put into it over 20 years. And all of this is tax-free, non-reportable income, okay? And you can see we're going to keep on pulling money out. So to supplement retirement income tax-free. So that's why this is cool. And this is one of thousands of different scenarios that you can show here, because we have full flexibility to access this money at any time. You don't have to wait till age 60. Okay, but there's that cost involved that we want to, make sure we're aware of. A lot of times insurance companies honestly don't understand the costs and don't explain them to clients, so the clients don't understand it, and then they get upset, and we want to avoid that at all costs. So here is the full cost. And here's the cool thing here. This is something we can be pretty darn close in knowing exactly what the cost is going to be, because the insurance companies are regulated to have to be able to mandate how it works. So of that $210,000 investment, growing, total cost that was added up for various reasons, average, it came up to like $33,000. Now, if we compare that to doing the exact same scenario, I'm gonna go over here real quick. The exact same scenario for just a mutual fund. So I picked a pretty standard one that a lot of military people use, the USA Target Date Retirement Fund. It's got an expense ratio of 0.79. And so we showed the exact same scenario, putting $10,000 in over 20 years But they're going to do. We're going to say, hey, bet they're probably going to do a little bit better, about 7%. Okay, so after those 20 years, they're going to have a little bit more money than we had over on the other side. Of course, they're getting better growth rate, and it's cheap. It's overall, it's a little cheaper in the earlier years. Total cost only $26,000. So okay, the mutual fund is definitely cheaper. Totally doesn't account at all for the ups and downs in the market and when you use the money and paying taxes on it, because that's all cost as well. But let's just say we're doing that now. Back to this is the 30-year cost. Sorry, typo there. But okay, let's look at 35-year cost. So let's look what happens when after we pulled that money out for a while, like we showed earlier. Obviously, there's going to be more costs involved because it's still insurance. There's cost of insurance involved, but you notice the other costs have gone away that help the insurance company manage the policies earlier on when they're taking on significant risks. So total cost over 35 years is 44,000. Okay, so that's cool, or not cool. But what we now need to show here is, okay, let's say we took this gain here and then put it back in the calculator. And by the way, this is the Financial Regulatory Fund Analyzer. This is the government consumer protection website. Yeah, everybody should come here, enter in their investments, and see what their costs are. So now we take that 400,000, we put it back up in here, and we don't make new contributions, but we're going to see what it looks like over 15 years. There we go. So I guess I can show you this just to show you how the cumulative costs add up. But back to this one. So we got 15 years of that, no additional contributions, but we are going to start taking that money out. Just to compare it to the Survivor Liberty Plan option. And this is additional, just in those later years. Again, at that same percentage rate of 0.79, we've got the same fund here. So on top of that 26,000 for the next 15 years, we're paying an additional 76,000. And we're pulling money out. It might be paying, depends if it's a tax qualified account or not, might be paying taxes on it. Market might be down, so we could be taking better losses. So this is just assuming you're getting 7% year after year after year. And that's adding up close to $100,000 now over that same 35 years versus the $44,000. So for whatever reason, the words have been out on the street that insurance is way more expensive than investments. Yeah, you can go get index funds that are cheaper, but typically if you're working with a financial professional, you're paying 1%, 1.5%. That's just industry standard, and it's still what the vast majority of people are doing because they want somebody to talk to. So it's important to be aware of what the real costs are. Why is this cost so more? Because the account value is bigger. The bigger the account value, they're still pulling the same 0.79%, and it adds up. It adds up a lot, and unfortunately, it's just a very confusing issue that people don't get around to understanding until it's way too big and almost too late to do anything about it. So that's why it's so important to address the Survivor Benefit Plan VGLI situation for you as early as possible, so that if you want to do an alternative, you can qualify for it before something goes wrong where you can't. So I hope this was helpful, and let us know if you have any questions. Thanks.